Understanding the difference between personal credit and business credit is essential for anyone who wants to build wealth, grow a company, or separate their personal finances from their business finances. While both types of credit deal with borrowing and repayment history, they serve two very different purposes and are built in completely different ways. Personal credit is tied to an individual's social security number and affects personal loans and credit cards. Business credit, on the other hand, is linked to a company's EIN and impacts business loans and vendor relationships. What is personal credit? Personal credit is your financial reputation as an individual. It's directly connected to your social security number and reflects how well you manage debt and repay money in your personal life. Every time you apply for a personal credit card, car loan, mortgage, or even utilities, lenders look at your personal credit report to determine if you're trustworthy. Factors that influence personal credit include payment history. Do you pay on time? Credit utilization. How much of your available credit are you using? Length of credit history. How long have you had credit? Types of credit. Credit cards, loans, mortgages, etc. Hard inquiries. How often are you applying for new credit? Personal credit is reported to the three major credit bureaus: Experian, Equifax, and TransUnion. Your personal credit score typically ranges from 300 to 850. What is business credit? Business credit is your company's financial reputation, completely separate from your personal credit. Instead of using a social security number, business credit is tied to your employer identification number, or EIN, and DUNS number from Dun & Bradstreet. This credit profile reflects how your business handles debt and payment obligations to vendors, suppliers, lenders, and creditors. Factors that influence business credit include payment history with vendors and suppliers, credit lines and business credit cards, the amount of available credit being used, public records like bankruptcies, liens, or judgments, and the time in business and financial stability. Business credit reports are maintained by Dun & Bradstreet, Experian Business, and Equifax Business. Business credit scores vary depending on the bureau, but typically range from 0 to 100. The higher, the better. The core differences between personal credit and business credit are crucial to understand for anyone managing both personal and business finances. Personal credit is linked to your social security number, which is unique to you as an individual, while business credit is linked to your employer identification number and business profile, which represents your business entity. Personal credit impacts personal loans, credit cards, and mortgages, affecting your ability to secure financing for personal needs. On the other hand, business credit impacts business loans, vendor accounts, and equipment financing, which are essential for the growth and operations of your business. Personal credit uses personal assets and income as collateral and proof of repayment ability, while business credit uses business assets and revenue, reflecting the financial health and stability of your business. Personal credit tends to have lower credit limits, which can restrict your purchasing power. In contrast, business credit can offer higher credit limits, providing more flexibility and resources for business expenditures. Personal credit is built through personal lenders, such as banks and credit unions, whereas business credit is built through relationships with vendors, suppliers, banks, and business credit cards, which can help establish a strong credit profile for your business. Lastly, personal credit protects your personal reputation, ensuring you can access personal financial products when needed. Meanwhile, business credit protects and builds your business reputation, which is vital for securing business opportunities and partnerships. Why is business credit so important? Number 1, it separates personal and business finances. Keeps your personal assets safe if your business takes on debt or liability. Number 2, access to more funding. Business credit gives access to larger lines of credit, higher limit credit cards, and better loan terms than personal credit typically allows. Number 3, protects your personal credit score. You won't have to max out your personal cards or use personal loans for business expenses. Number 4, builds business credibility and trust. Lenders, suppliers, and partners trust businesses with strong credit. Number 5, improves cash flow. Vendor accounts offer payment terms like net 30 or net 60, giving your business time to pay after receiving products or services. Number 6, essential for growth and scaling. If you want to lease commercial property, purchase vehicles, or secure large contracts, strong business credit is often required. Building business credit isn't just for big corporations. It's for every entrepreneur, small business owner, and side hustler who wants to operate like a true CEO. If you found this information valuable and want to learn more about building and leveraging business credit the right way, make sure to like this video, subscribe to the channel, and hit that notification bell so you never miss another tip that could help you build, grow, and fund your business. Your support helps us create more content to guide you on your entrepreneurial journey. Thank you for watching. Remember, credit is power, but only if you know how to use it.